Have you ever wondered what happens to a massive global defense company's balance sheet when geopolitical tensions hit an absolute boiling point, right? Like, do they just sit back and print money, or do their supply chains completely buckle under the pressure? Well, today, we're cracking open the May 2026 SEC filings for Elbit Systems. Specifically, we're looking at their Q1 6K earnings release and their Form SD, just to find out exactly what happens when surging global demand collides with intense operational friction. And we're kicking things off with a massive number, $30.2 billion. That is the record-breaking order backlog Elbit Systems reported at the end of this first quarter. Welcome to the EDGAR Brief. We take dense SEC filings and, well, translate them into plain English for the everyday investor. I'm your host, and today we're decoding Elbit Systems, ticker ESLT. Quick note before we jump in, we are entirely independent. We're not affiliated with the SEC, and we're definitely not financial advisors. We use AI to help summarize these huge documents so errors can happen. Always verify the numbers on sec.gov before making any actual money decisions. No hype, no price targets, just the facts translated for you. Okay, here's our roadmap for today's explainer. We're going to start with their business model, run through the scorecard, do a quick moat check, read between the lines, look for red flags, and finally give you the bottom line. Section 1, the business model. Let's get right into it. To really understand Elbit Systems, you have to know what they actually make. Basically, they're an international, high-tech defense company based in Israel. They sell advanced systems for land, sea, and air. We're talking everything from uncrewed autonomous drones and precision-guided munitions to electronic warfare and cyber intelligence. Their customers, governments and militaries all over the world. And how does the money actually come in? It's mainly through these massive, multi-year government contracts. Which brings us to the absolutely most important phrase for a business like this, order backlog. When you hear backlog, think of it like a wildly popular restaurant's reservation list. Elbit has already taken the orders, the contracts are signed. They literally have guaranteed diners lined up around the block for the next 2 years. So they don't really need to spend heavily on marketing to find new customers right now. They just need to get into the kitchen, cook the meals, and serve them to get paid. Section 2, the scorecard. Let's see how well they're actually cooking those meals. Looking at the raw numbers in this filing, the best way I'd frame Elbit Systems right now is a cash cow in a war zone. Let's walk through these 4 key figures, because this is where the rubber really meets the road. Revenue is up 15%, jumping from $1.89 billion last year to $2.18 billion this quarter. Gross margin also expanded from 24% to 25.2%. Now, if you're new to this, gross margin is simply the meat left on the bone after you pay the factory workers and buy the raw materials. So for every dollar they sell, just over 25 cents sticks around before they even pay for administrative offices or R&D. And because of that expanding margin, their operating income surged 37% to over $205 million. But hands down, the most impressive number here is the bottom one. Operating cash flow. It grew by a whopping 53% to $281 million. You see, profit on an income statement, it can sometimes be a bit of accounting fiction, shaped by depreciation or deferred taxes. Cash isn't. Operating cash flow is the real, tangible cash left over from running the actual business. And right now, Elbit is generating a ton of it. More dollars are clearly walking in the door. You can see the double-digit revenue growth year over year right here. They are successfully converting parts of that massive backlog into actual recognized sales. Now, what's really fascinating is where those dollars are coming from. The geographic breakdown notes that since the conflict began in the Middle East in late 2023, there's been a material increase in demand from the Israel Ministry of Defense. And you see that right there. Israel makes up 37% of their Q1 revenue. But hey, do not mistake this for a purely regional business. While local demand is definitely surging, a massive 71% of their overall $30.2 billion backlog is actually for orders outside of Israel, primarily in Europe and the Asia-Pacific region. Moving right along to Section 3, the moat check. So, the money's good right now. But why couldn't a smart competitor just set up shop tomorrow and crush them? What exactly protects Elbit's business? Well, the answer lies in their structural advantages. First off, they have incredibly sticky multi-year contracts. I mean, when a country buys an artillery system or drone fleet, they're also buying a decade of maintenance, software updates, and training. The switching costs are astronomically high. A military customer would absolutely scream if they had to rip out all their integrated tech just to switch to a competitor. Second, Elbit provides an end-to-end defense ecosystem across land, sea, and air. And third, just their sheer scale. Nobody can easily match a company with a $30 billion backlog. Just look at the $1.4 billion contract they won in May for European military modernization. You don't win those bids unless you are deeply entrenched and highly trusted. All right, Section 4, reading between the lines. This is my favorite part. It's where we look at the management's discussion and analysis to see if the executives are actually owning their results or just making excuses. Are they focused on the right things? Take a look at this quote from CEO Bezalel Magalis. It tells you exactly what keeps management awake at night. Notice he isn't talking about finding new customers. He's talking about capacity, scaling production, increasing automation, and robotics. They know they have the restaurant reservations. Their entire urgent focus right now is figuring out how to speed up the kitchen without blowing up their costs. They desperately need to chew through that backlog efficiently. But, it's not all smooth sailing. That brings us to Section 5, red flags. If you read the risk factors section of literally any SEC filing, the lawyers include everything up to and including an asteroid strike. We want to skip that boilerplate filler and look at the real, immediate operational dangers unique to Elbit right now. The filing explicitly traces a cascade of geopolitical headaches. The ongoing conflicts in the Middle East have caused some severe supply chain friction. For example, the Houthi movement's attacks on shipping in the Red Sea, that has directly increased Elbit's transportation costs and caused major delays, which then led to material and component shortages, forcing Elbit to pay elevated prices just to secure what they need. On top of that, they've had to manage workforce disruptions because of employee call-ups for reserve duty in Israel. Now, while recent ceasefire agreements have reduced these effects slightly, management is very clear. If stability doesn't hold, these incredibly expensive operational constraints could easily return. And speaking of supply chain headaches, we also dug into their Form SD. This is a specialized disclosure regarding conflict minerals. See, to build high-tech electronics, you need tin, tungsten, tantalum, and gold. And Elbit is legally required to audit their supply chain to ensure these minerals aren't funding armed groups in places like the Democratic Republic of Congo. The fine print reveals they are tracking materials from 349 different smelters and refiners globally. It brilliantly illustrates the immense hidden complexity and cost of just sourcing the basic raw ingredients they need to build their products. Let's see how this all builds to our final verdict. Section 6, the bottom line. Ultimately, Elbit Systems is a cash-generating defense contractor defined by one core tension right now. Their main strength is an incredibly in-demand, end-to-end tech ecosystem backed by a guaranteed $30.2 billion multi-year backlog. But the main thing to watch is the friction of fulfilling it. They are highly vulnerable to global supply chain shocks, spiking transportation costs in the Red Sea, and potential execution delays if they just can't get the parts or the people they need. So the crucial point is knowing what to look for next quarter. Here are 3 specific things you need to track. First, backlog execution. Look at their revenue next quarter. Are they effectively cooking the meals and turning that backlog into sales? Second, margins. Keep an eye on that 25% gross margin. Is the friction of high shipping costs and component shortages starting to eat into their actual profits? And third, geopolitical ceasefire stability. The filing states that recent ceasefires helped ease operational constraints. If those hold, their supply chain normalizes. If they fail, costs go right back up. Which leaves us with the ultimate question. Can Elbit efficiently turn its record $30.2 billion backlog into real cash before global supply chain cracks widen? That's your EDGAR Brief on Elbit Systems. Remember, this was an explainer, a translation, not a recommendation. Read the original filings on sec.gov if anything here piqued your interest. Thanks so much for being with us today, and we'll see you in the next filing.